Hello, options traders. Welcome, everybody, and I hope everybody had an awesome weekend. And I thought I would just post a video here with an intriguing question. How would you like a strategy that wins 80% of the time? Now, it doesn't really have to be 80%. I just threw that out there, meaning some strategy that has a very high percentage of wins, what sometimes traders call this win rate. Now, I'm sure a lot of people are thinking, of course I'd like to know that strategy. You don't need to know anything about options to realize that if you're winning 80% of the time and losing 20% of the time, that you've got this huge edge and you're going to make lots of money. Well, the reality is you do need to not know about options or markets to think that that's going to give you an edge. Why? I've talked about this in previous videos and most recently in the fair value video. Remember, price is the equalizer. Everything gets equalized because of price. Very much like in a football bet. If one team has an obvious advantage, it's going to get reflected in the point spread. Don't kid yourself into thinking that because you read the star quarterback is going to miss this game, that suddenly you have an edge by betting on the other team. And yet that's what a lot of traders do, and they step into a lot of traps by forgetting that price equalizes risk and reward. And so this is why you see a lot of banner ads like this, one I just happened to stumble across, how to win 97% of your options trades. And people immediately think this is great. I'm going to have this huge win rate and I can't lose. I'm going to make tons of money. Let me sign up for it. And it's just meaningless junk. Why? Well, let's say I'm going to offer you a type of a trade here. And we're going to throw 10 numbers into a hat and I'm going to draw a number. And if we draw the numbers 1 through 8, you're going to win $1. You're going to win 80% of the time. And you might say, well, that sounds like a great deal. If I win 80%, lose 20% of the time, I'm going to make tons of money. But what you're failing to realize is I'm not going to do that dollar for dollar. I'm not going to pay you $1 every time you win and only receive $1 every time that I win. And again, we talked about this in the fair value class. What is the fair value of this game? Well, it should be $4. And if you go back to the formula that I talked about in that video, we can figure it out by saying you're going to win 80% of the time, multiply that by the dollar you're going to win, and then you're going to lose 20% of the time, so we multiply that by the minus $4, which is theoretically what that bet is worth. And if we multiply those out and add them up, we come up with this net number down here of 0, what's really called the expected value in statistics. And what that means is that that is the number you should expect over long periods of time of doing this bet. You're not going to make any money because it's been factored into the price. In other words, if you want me to play this game, I'm not going to do it for $1 if I win. I won't do it for 2. I won't do it for 3. That will definitely give you an edge. By the same token, if I want to charge you $4.05 or $4.10 or $4.50, anything above 4, you're going to say no. So at what price will we eventually say, you know what, I'm willing to trade, so to speak, at this price? It's going to be at $4. So if the markets have a strategy out there that wins 97% of the time, and there's tons of them, I can show them to you all day long for free, don't be fooled into thinking that you're not going to pay for that advantage. You will. Let's take a look at an Excel spreadsheet that actually takes us through this game. Now over here on the left, I have the probability for winning at 0.8. We can change it, but I'm going to leave it at 80%. And I'm going to say that the price is 3. In other words, you have to pay me 3 every time you lose, and you're going to win $1 every time that you win. Yes, you do have an edge here. So this graph over here on the right shows one possible path of 1,000 different attempts at playing this game. And look what happens. In this particular series of 1,000, you were up $186, this number in red. What could you expect to happen over many, many series of these? What if we did this thousands and thousands of times? That's what's showing in this column. And what this does is it runs each of these 1,000 trials 1,000 times. And it takes the average. And so this number right here in green is the average of 1,000,000 tries. And it looks like we're getting close to $200. Let's try another one. And once again, we can see that the graph has this very strong upward bias because you do have an edge. And in this particular series of 1,000, you came up being up $190 at the end. But look what the average would be, around $200. Why does this average seem to be centering on $200? Well, if you run those current numbers through the formula and pay $3 for this bet, 80% of the time you'll win your dollar, 20% of the time you're going to lose 3. Multiply them out, add them up, and what do we get? Positive 20 cents. And that means that on average, you are winning 20 cents per try. So if we played 1,000 times, take 20 cents times 1,000, there's your $200 average. There's no question that you have an edge in this case. But what people fail to realize is that nobody's going to sell it to you for 3 for this very reason. So just as a recap, we could do this over and over and over, and you would always see a very strong upward bias like this. And that's because you are paying below fair value. What if we made this number more than $4? Let's say it was $4.50. What's the graph going to look like now? Now you can see you have a long-term downward bias. The graph is definitely going to take you into negative territory. Can you win in the short run? Sure. You can see here if you were to zoom in very closely, there were some times that you did get into positive territory, but it's not going to last. It's going to be a long-term losing deal. Why? Because you're paying more than fair value. And if you were to run these numbers through the formula, you'd see that you're going to have an average loss of about $100 after 1,000 tries. So what happens if we make the bet fair? Let's price this at $4. And now we get this nice sideways looking graph over long periods of time. And you can see in this particular sequence of 1,000 tries, you ended up being down $13. It didn't really make any money, didn't lose any money. And over here is our average after 1,000,000 tries, basically flat. That's what we would expect. But here's another catch too. Look at this. Are there periods in here where you could have made money? Sure. Even though it's a fairly valued bet, you might actually make money. And so that leads a lot of these novice traders and websites that say, oh, you've got an 80% chance to win or a 97% chance to win. Look, we've got a track record to prove it. We're making money. And my response is always the same. You haven't been doing it long enough. Of course you could end up with a winning record in here, but if it has a 97% chance of winning, you're paying for it. The market's going to reflect it in the price. So is that always going to happen in the markets? Well, let's take a look at a platform and see. We're looking at Facebook, and the stock closed just under 194. And let's take a look at some vertical spreads. Now, for those of you who are new to vertical spreads, it's a strategy where you're going to buy an option and simultaneously sell an option. And the most you can make is the difference between those two strikes. So for example, let's come down here to this 185-190 pair. And if you bought this vertical spread, you're long the 185 call, you'd be short the 190 call. And that means you have the right to buy shares at 185, the obligation to sell them at 190, and therefore the most you would make is $5. Well, think about this. If the stock is currently 194, both of these options are in the money. It looks like this is a high probability trade. It's probably going to expire with intrinsic value and therefore be worth $5. Does it mean you have an edge? Let's see how the market priced it. Look over here, and the mark is about $4.20, $4.18. You have to pay for that advantage. What happens if you bought this one up here, the 180, 185 strike? Now you got to pay almost $4.70. Yes, you're getting closer and closer to being guaranteed to win $5, and that means it's going to be reflected in the price. So yes, we can always make these high probability trades, but don't kid yourself into thinking the market's not going to charge you for it. I mean, we could look at the 150, 155 spread, and it's going to be priced at $5. You can't even make money from it. Now, what happens if we look at, let's say, the 200, 205 strikes down here? It's got a low percentage chance to win. Both options are out of the money, and the market realizes that. Yes, they're going to lower the price here to about 53 cents. Risk and reward balanced out by price. Could you win this? That's a long shot, but if you do, you're going to make a lot of money. So you can't say this is necessarily a bad deal because the price reflects it. You're not spending a lot, you might make a lot. What you can say is that it's low probability. And see, that's the little catch that these websites don't tell you. Or other traders who say, I've got a technical indicator, I've got a trading style that wins 97% of the time or 80% of the time. They're not telling you that you're going to pay for it. So any strategy that has a high probability of winning, we could really turn that on its head and say it's another way of saying you have a small probability of losing a lot of money. And if you worded it that way, most traders wouldn't want any part of it, and yet that's what they're stepping right into. But now what would happen if we increase time? Let's come back up here to this 185, 190 pair. If I increase the time to expiration, wouldn't you expect that the probability would decline? It's kind of like saying your football team's in the lead with only a few seconds on the clock. You've got a very high confidence level that that's going to be a winning team. Same thing here. I've got a fairly high confidence level. This is going to be a $5 spread here in 13 days when it expires. I've got a very low confidence level down here. What's going to happen as I increase time? Well, my confidence here is going to go down, and therefore the price is going to fall. The value of the spread will drop. What about this pair down here, the 200-205? My confidence is going to go up. I have a better chance of making money. It's like your football team losing, but we've got a lot of time on the clock. My confidence goes up. So we should see this price drop from 417, and we should see this price increase. So watch what happens when I add time to the clock. Here's the 185, 190 pair. It drops to 375. Here's the 200, 205 pair. It increased to about $1.14. The market reflected the probabilities in terms of price. So the main thing to understand is that whenever you hear somebody touting a strategy or a system that has a high percentage chance of winning, the part that they're not telling you, or they just don't realize, which is probably worse, is that you're paying for that. So the better way to approach the markets is to say, what are your goals? What percentage return do you need to meet your goals? And then let's figure out the strategies that allow you to do that with the least amount of risk. In other words, we're going to take only enough risk to accomplish those goals. And once we do, we're going to hedge, roll, and morph to stay in those positions. So keep that in mind the next time you see these banner ads telling you here's an option strategy that has a 97% chance of winning. It's just another way of saying you've got a small chance to lose a ton of money. And for anyone who'd like to learn more about the art and science of options trading, please join us on the Facebook trading group OptionsAtoZ.com.